Thank you so much. Please take your seats. I hope you had a good coffee break, and I think you would agree we had a very dynamic, very forceful beginning to the fourth Navigating the Future conference here in Dubrovnik. And we're going to take that energy and we're going to take those insights into the next session, which is titled Navigating Fragmentation, the Role of CESEE in the Single Market. And once again, we will have four formidable speakers who will share their insights into a very pertinent topic. And the second session will be moderated by Euronews's business editor, Sasha Vakulina. And with that, please welcome the moderator and her four speakers. And all four panelists also please join us up here on stage.
Thank you.
Sasha, the floor is yours.
Thank you, Ali. Please join us, please. Oops. Thank you for inviting us. Thank you for being here. This is like, I don't know, tens of pages that I put the notes into from the first session. I'm sure that you all have done the same because there was a lot of food for thought there. And some of these issues we're going to narrow down to this region, and we are going to discuss now during our second session of the day. Indeed, navigating fragmentation, the role of Central, Eastern, and Southeastern Europe in the single market. We do have a couple of slides prepared, so just to talk you through the flow and how this session will be structured and what are we going to discuss. We will touch upon, in the beginning, the successes. We're going to discuss the access to the EU market, supply chain integration, and structural reforms. But as you all know very well, it's not, unfortunately, that rosy and peachy, and there are still things to discuss and debate. We are going to look at the conditions and the situation we are all in regarding the uncertainty, regarding the energy market, trade, defense, and the economic order. We're going to also try to analyze, because this is a topic on its own, the scope for single market deepening, and you can see here some of the percentage over the trade integration when we compare the situation with the EU 27, NAFTA, ASEAN, Mercosur, and the United States internal. I'll keep this slide for a moment here so that you could take a look at it. And this is, well, this sets the scene as well when we're going to discuss the region that we are here to focus upon. Reasons for limited progress. Now, this is something we're going to try also to go through, but in this case, we're going to also go through all those reasons with you, because please get ready to participate. We do want to hear from you and your views on this. We're going to be discussing the consensus requirement, divergent interests, reluctance to cede control, uncertainty of benefits, regulatory gold plating. These are just some of those, and you will hear more about those from the speakers on stage, and us on stage here will hopefully hear more about it from you with us. So here we go. The questions briefly are the impact of fragmentation, CESEE business model, and EU-level reform priorities. This is something that you can expect to hear from us over the next hour. Specifically, my greatest pleasure, let's go introduce our speakers. Piroska Nagy-Mohacsi, she's a visiting professor at the LSE in political science. Zsolt Darvas, senior fellow Bruegel. Debora Revoltella, chief economist at the EIB. And Ivailo Izvorski, chief economist at the World Bank. Thank you very much for being here. Great to have you. And before we go, I would like to open something that the team kindly prepared, which will be the poll. We are asking all of you to participate and to look at it. So there are two ways of doing it. You can either scan the QR code that you can see, and we tested it extensively. You can scan it from any place in this room. That was tested and done. We did it. What are the reasons for limited progress with EU-level growth reforms? You have the options. You can choose up to 3. Let me go through them. Giving up part of sovereignty, cannot compromise, political positions too far apart, benefits not clear, too many countries involved, high budgetary costs. Now, you can either scan the QR code or you can go on slido.com and use the code. You can see it with the hashtag 4144370. QR code is actually easier, I mean, honestly, but all up to you. You have up to 3 options, and as of now, you can see it moving, and we do have a very clear leader regarding giving up part of sovereignty. I would like to keep it on for a minute. Please, let's keep it on here. Now, the audience have an option of voting up to 3 options, but you're the speakers on stage. I'm going to start with very briefly asking you to vote, but choosing only 1 option. Piroska, what's your 1 option out of this choice? What are the reasons for limited progress?
It's the political willingness. It's the political willingness and the lack of internalization of the grave risks that Europe faces.
So that would be.
So I don't know where you put it. That's what I think. How you say when politicians are not selling the right product? Where do you put that?
Well, for this we need to organize another poll, but you know, I've asked you to choose one of them. We really worked hard on trying to find a couple of options.
It's probably on the surface, I would agree with the audience that giving up part of sovereignty, but it's a false choice.
Zsolt, what's your vote? Where it goes?
Yeah, also among these 6 options, also my vote would go to number 1, I mean the A, which most of the participants voted for. I mean, I would add that you know, some countries might want to benefit from, you know, some little fragmentation across the borders because they might think that, you know, this is somehow favors their domestic suppliers and limits competition. So I think it would be best categorized as number A.
All right. Debora, what's yours? And I've just noticed something. We were really working hard on this to make sure that the QR code is visible and workable and everything. I do know that we have an interesting order of being A, C, B, but please excuse us for that. You can choose, like, let's put it 1, 2, 3, 4. Just vote for the option that you choose. Sorry about it. Debora, what's yours?
I think I agree with giving up sovereignty, but I think there is also something related to benefit not clear, in the sense that you give up sovereignty if you understand that you will end up in an equilibrium scenarios where the benefit prevail. The risk that many countries face is that if they give up, they are not sure the others will give up at the same time, and then you may find yourself in a scenario that is worse than keeping your sovereignty. Right. So I think we are in a kind of a prisoner dilemma, game theory, and we end up in a situation in which everybody sticks to keeping the control, while the equilibrium of really full integration in Europe would bring up benefits that are much higher for everybody.
Ivailo, what would be your vote in this poll?
I think there are often too many countries involved for when unanimous decisions are needed. It takes a very long time. And then there is also a bit of a free riding, right? I mean, there are 27 countries. Yeah. Why do we have to take the lead? The reforms could have a domestic challenge, right? And so why do we have to do that? Let's wait for somebody else to do it.
Yeah. Well, that's kind of an interesting unanimity here on stage. So let's fix it here. And what we're going to do, the poll will remain open for all of you. And we're going to go back to it by the end of the session to see if we anyhow managed to convince you to change your mind, or whether you have other conclusions, or whether you thought, oh, maybe this is actually of more importance. Again, since there are up to 3 options, you do have this flexibility to change your vote. So for the moment, we have 61% giving up part of sovereignty, 54 political positions too far apart, 41% for cannot compromise, then equal 22 and 22 benefits not clear and too many countries involved, and high budgetary costs 20%. So you can keep voting and keep expressing your views there. You can always change as well on Slido. You can always change at any stage of it. So we're going to go back to it. So with this, let's go to discuss some more details of what we mentioned in the poll, and we're going to focus in the beginning on how the fragmentation affecting the region and what is the business model in the European economy in the future. Ivailo, I would like to ask you, please, to start, and for the first question, I would like to ask you, how do you think the economic and geopolitical fragmentation, reflecting both the IMF and the EU concerns, impacting the region's growth prospects and business models, also regarding the fact that recent downgrade of the regional growth was put to 2.4% for 2025.
So clearly the European Union has been a huge push for the countries of our region, the CESEE countries, to converge rapidly to EU levels. You know, every country that has become a member of the European Union has become a high-income economy. It's a massive improvement. Since 1990, 27 countries around the world have become high-income. 13 of them are in the European Union, and the other are resource-rich, oil and gas-rich, or tourism-dependent islands. So the EU obviously has been a huge impetus for development of both EU members and applicants, or those that may not have even a chance to join the EU. Why? There's been an alignment of institutions, and even those that are not joining the EU are trying to replicate those institutions in the EU that work very well. There's been a surge in trade. I mean, you know, in our region, Czech Republic, Czechia sends 80% of its exports to the EU. Bulgaria sends 65%. On average, it's about 65%. Huge role for trade, huge role for investment. 70% of FDI to the region is from the EU, whether it's through value chains or other means. So it's a massive push for the maturity and the convergence of the region. And so therefore, any fragmentation, whether it's global or within the EU, I think it has a massive impact, negative impact on our countries. I mean, somebody was mentioning earlier, you know, among the countries of the region, the highest share of exports to the US is 5% for Turkey. This is the lowest share of exports in East Asia for Australia. So our countries are not directly exposed to the US, but they're massively exposed to secondary effects through the European Union. So the way the EU is performing in the world and the way the EU is performing within itself is, I think, it's massive positive or negative impact. And so therefore, I think it matters tremendously in more difficult times as we have now. How do we address the internal fragmentation in the EU? There are a lot of sources of inefficiencies, a lot of sources that could be addressed to deliver faster growth in productivity and in jobs and in output. And so therefore, I think this is absolutely essential. Let's focus on that because it benefits the EU, but benefits our countries as well.
Debora, based on the latest EIB investment survey, what are the main opportunities and the risks for these region countries as they are trying to, as well, adapt their business models and investment strategies?
So I very much think I follow the storyline. I think that we all have in mind the fact that the region has massively benefited from EU integration, and I think we should never forget it. There is the income conversion part, the trade part. One data that we also were looking at is that if you look since 2000, the export performance of some of the countries of the region is really like Germany, like Korea. So it's really a pickup of this region that has become central in European value chains, but also extra EU trade is quite relevant. And also there is another element that I think it's quite interesting in the financial market shocks that we have seen after the US trade tariff mess. Europe overall is more considered as a safe haven, and countries in the region, most of them has also benefited, also the non-Euro countries, of being safer than the US, if you want. There were some countries more affected for local political uncertainty, but mostly the region has been benefiting. So I think we start from that point. There is one point of which I was reflecting related also to the panel, and probably because most of these countries are small economies, they are today also experiencing somehow more than other countries the cost of the unfinished work in terms of integration at the European level. And we have our survey that looks at European firms. We do it every year. We monitor different the developments. And there are a few data that I think are quite interesting. One, we asked the firms if they export to another EU country, whether they face barriers in the market. Now, overall in Europe, 60% say they face a barrier. They shouldn't, because in an integrated market, you should have no barrier intra-Europe. 60% European level say there are barriers. In Central Eastern Europe is 80%. So I was thinking that's related probably to the unfinished market, and by being a smaller economies, they have more frictions and they face it more. The other point is there is also some internal work to be done. We calculate what we call the cost of bureaucracy is coming from asking the firms how many people they are fully dedicated to dealing with bureaucracy. It comes out that at the European level is some 1.5% of turnover of the companies, this cost of bureaucracy. In Central Eastern Europe is 2.5, so small numbers, but the energy bill for companies is some 4% of GDP, so 2.5 is not so little, and the region seems to have a little bit more. So there is also some internal work related to easing the business environment that the region should look at. And then another boundaries, if you want, in terms of that the region may be experiencing is related to the financial side. If you want, the region is quite integrated on the banking side, and that's we all know that banks are quite ramificated in the region, international banks operating in the region, and they really have a rule in terms of integrating the market. But on the capital market side, the lack of a European integrated capital market and the investment and saving union in the region is more perceived because they don't have very strong markets and very big market on their side. So the lack of the integration at the European level translates even stronger in the region. And I think it has two elements here. On the one side, it's the return on household savings that remain very low, and the whole story of all saving only going to very traditional form of investment with very low returns. But on the other side, that innovative firms don't have financing, and the solution in the region, it's tricky because many countries are looking at how to deepen their own capital markets, while the real point is also how to integrate capital markets and how to have flowing resources that come from all over Europe, also in the region. And I think that's an important element to look. So, in fact, I think the EU integration results is very strong in the region, but they may face more the cost of the unfinished work. We go to a second point, and it's in the current situation, finishing the work is fundamental. It's fundamental at the European level, and I think it's very important also for the region. It's a fundamentals because at the end, we end up in a situation in which Europe has an opportunity to become a third pole, with US kind of a declining rule and China on the other side. Europe has the opportunity, and it's a once in a century opportunity of strengthening the international rule of Europe and of the euro. And I think that has to come with more integration also at the European level. From the discussion we are having, I think there is a risk that if it's not coming through the integration, some countries will try to find the sweet spot of having like the Dubrovnik case that was quoted, of finding the Singapore rule of a small open economies trying to have advantage. But I think the equilibrium of a more integrated Europe is much better for the single countries and for Europe overall.
Piroska, so let's follow up on what Debora said with you. So in this case, it means that when it comes to fragmentation affecting the region and Europe's business model, and this is kind of leads us to some kind of a new growth model concept.
Yes, I think we can be a little bit bold. So beyond the wonderful, important measures and avenues that we already have heard in the first panel and now in this panel from my colleagues, I think we can maybe step back and say, what are the biggest challenges and risks Europe faces, and pare it down to two, which thus far, as I can see, have been dealt separately. One grave challenge clearly is the weak military capacity. As the commissioner yesterday so brilliantly explained, you know, we are at war. Europe is at war. It's being hot war in Ukraine, but Europe has to wake up to the fact that the imperial power neighboring Ukraine will not go away. Its ambitions will not go away. And at the same time, the traditional security umbrella that Europe has accustomed to and we have enjoyed tremendously as a little bit of a free rider from the US is fading away. And that's putting it mildly. So we have weak military capacity to defend Europe in a hot war, and in general to have a defensive position to deter war. Now, that has been recognized, as the Commissioner has also said, and several others. There is a European rearmament plan and all that. Germany, which probably should be at the center of this, has changed its debt rules to allow for more military spending. Perhaps at some point the ECB will also come into this game, given that this priority. But you know, so this is recognized as a separate issue from all the second threat, big grave risk, is the stagnation of Europe, the declining productivity, and the relative, growing relative innovation gap toward the US. That's the Draghi report, that's the latter report, we've heard here excellent IMF reports, EBRD, EIB reports, World Bank also. But the two things are kept separately. We have to link the military imperative with the economic growth imperative. And I think it's unavoidable. It's not a pleasure to say I'm a peace generation, right, and pro-peace. But we are in a new reality. We have to internalize the new reality that we have to have a high-tech-led defense industry to lead the new economic growth model. I think it's inevitable. It's inevitable. Link the military imperative with the economic imperative and have a high-tech defense industry-led economic redevelopment for Europe. Now, nations have tried it. Some failed, some have been successful. And I'd like to argue to you that despite very country-specific circumstances, you know, Israel's example can be examined and can be usefully applied where it's applicable, where there is a determined, inevitably, given the security situation, there's a determined focus of defense-oriented, high-tech defense-oriented economic development, and where there is a clear strategy, and there are government programs. I mean, this is a different conference, but programs, incentives, high R&D, high subsidies, with a lot of domestic component to incentivize high-tech development in the army, which then filters down, not trickles down, you know, that we like to have. No, it filters down intentionally to the non-military sector. It is also helped, of course, by the unique situation that there is conscription, even though in the end only like 55% of the Israeli youth is serving in the army, but they go through a high-tech training. Today, in the startup nation, 90% of the non-military, so the regular civil startup, in the startup nation, which Israel is often called, 90% of the managers are coming from military service, 90. The army is being used for both, R&D development and human capital development. Now, I recognize, of course, that Israel is special. There are stuff that we don't like. I don't like what is going on in Gaza. But let's learn what is to be learned, and have a much clearer high-tech defense industry-led economic development.
So that's the rethinking of the new possible model, as you see.
And I think, that should be the European model. And then Central Europe, and for that matter, Ukraine also, would be beautifully fitting into this according to different comparative advantages.
Zsolt, I would like to go to you for this part regarding the fragmentation, because within the EU, and also to look at it in a bigger picture, look at it globally, affecting the integration into value chains for this region, what do you see as the implications as well of how this region is being exposed to this shifting trade dynamics, but nowadays not only the shifting dynamics when it comes to the US, because we understand that the trade policies and strategies have been changing dramatically there, but also on this dual side of the US and China at the same time, because that's another angle to look at it all.
Yeah, so when we indeed talk about fragmentation, we can consider two issues. One is a more static picture of fragmentation within the single market. And the second one, which was in your second part of your question, that global trade and also finances might be a process of becoming less integrated. Now, let me spend on both of these issues a few seconds. So on the first one, on the internal market fragmentation, so I would first would like to start with some big picture numbers. So yes, internal market is fragmented. Also, EIB report, World Bank reports, all kinds of reports show that. If you look at the Commission single market strategy, which was published last week, it argued that the European single market so far boosted the level of GDP in the EU by 3–4%, created 3.6 million jobs. And if all the barriers would be eliminated, then we would basically double this. So we could get another 3–4% level shift in GDP, and every cent, every penny matters. But if you look at what this region, the Central Eastern European region, achieved over the past 20 years, I mean, this is nothing. I mean, also Ivailo and the previous panel talked about, I mean, Poland more than doubled its GDP over the past 20 years. The two weakest performers were Hungary and Croatia, both growing but still growing by 45%, so almost one half. So what comes from the existing growth model seems to be still working, even if there is fragmentation. Now, I don't deny there is no fragmentation, and there is fragmentation. I will come to that shortly. But the big picture is not that bad. And I mean, if I can also use this to put into perspective these dramatic numbers from the IMF research that also managing director mentioned, that within EU fragmentation is equivalent to about 45% tariffs on goods and 110% tariffs on services, which are really shocking numbers. But these numbers that there's such a huge cost of intra-EU trades, for me at least, doesn't somehow align with what we see in the data. Now, earlier this week, we had an excellent discussion with one of the report, or this IMF report authors, Lorenzo Rotunno, and he very well explained all the econometric details of these calculations, which I think it was very well done, and they controlled for everything and applied for the best estimation technique and so on and so on. But I think there are two issues, if I can be also a little bit critical of one of the studies of our host with that. One is that is the actual data used, because certainly there is no official statistics on intra-country trade, so various approximations exist, and they usually lead to somewhat similar results, but still this is a data which is non-existent and somehow approximated. So, because the study compares how much trade there is within country and how much trade across borders within the EU. So one is a data issue, but also there is also, I think, a preference issue, which we also discussed with Lorenzo, that the fact that French people drink French wine and Italian people drink Italian wine, it doesn't mean that there is any distortion between wine trading between France and Italy, but maybe there are local preferences, different culture, different languages. So a little bit, I think, this is overstretched. But nevertheless, there are certain major differences and frictions in the single market, as also the Commission's proposal last week emphasized, and certainly, I can mention maybe four. Certain is regulatory divergence. So even though EU is governed by lots of directives, which EU member states have to incorporate into the national laws, they are not doing that always the same way, and we can discuss that later. There are also lots of problems with both the implementation and also the quality of that. There are also lots of infrastructure bottlenecks also for the region, including connectivity with Western Europe, certain labor markets, and also financial fragmentation leading to somewhat higher risk premia and credit rates in the region is also an issue which should be tackled, as also Debora mentioned. Now, let me also quickly go to the global issue, because the time is.
No, it's okay. I just wanted to specifically ask you about the global, because it's important to look at it from different dimensions, right? Because that's all happening also at the same time.
Yes. So again, for the global, as Ivailo already mentioned, the countries in the region are, the direct exposure is relatively limited to the United States, but indirectly, we are Germany and the various value chains. Certainly, they are much more exposed, and in fact, if you look at also the trade data that you just mentioned, the trade as a share of GDP is huge, and most of this trade is intermediate goods. So it does show that the region is very deeply integrated into the global European value chains in particular, but also to some extent also broader global value chains. Now, so I think what's happening certainly creates both risk, but also creates opportunities. Now, so on the risk side, we certainly don't know, what will happen in the US. In one day, Donald Trump decides something, 2 days later suspended for half a year, then another day a court blocks it, then an appeal court reverses the block of the trade measure, so we don't really know what's going to happen. But nevertheless, I think it's quite likely that after all, EU-US trade is going down, and EU-China trade is going up. And again, through the exposure of producers in the region via value chains, they are very much exposed. But also this uncertainty, I think, creates a great opportunity, because many companies might think about this so-called, near-shoring phenomena, namely bringing, suppliers closer to their borders. Also during COVID, we saw major disruptions from value chains integration with China. And obviously the region, it's due to geographical location, is perfectly suited to that. So I think the region can benefit. Now the key issue is, what to take from the US and what to take from China if, German companies want to bring that forward. And certainly this should be used for a kind of increase certainly in the value added of companies in the region. I think it's very well recognized. It has been said for years. But also this global fragmentation, I think, increases the pressure and the need to move a little bit up on the value chains, because somewhat middle and lower level integration might level off after some time.
Let's follow up on that, Piroska.
I very much agree with what Zsolt has said. I would maybe bring another kind of global point in, if I may. And I want to maybe highlight here, may not be that necessary, but I think it was very impressive to hear from the ECB president the other day in Berlin to fully embrace formally the global euro idea. Now, the global euro idea is that by design and by default, the euro can step in and take up some of the roles, take over from the US dollar as some serious mistakes are being done in government policy in the US. So we have, of course, seen the declining role of the US dollar very, very little, and there's no question that the US is still the global reserve currency. But the whole concept that Europe actually can step in, the euro, for me it's almost the same, Europe and euro in a sense, and it has a certain meaning for this region particularly. So that the euro can be a global currency, it can have very significant benefits. It almost can be a strategy, as Madame Lagarde said. Europe has to earn it. Of course, US has to do a lot of bad stuff, but Europe has to earn this. The Eurozone has to earn this. The extraordinary privilege that comes from taking up more of this role. The lower borrowing cost that is likely to come from this, maybe some benefit from the exchange rate, less volatility if more trade is invoiced in euro, and the geopolitical power that comes from that in many forms. Let's not go into that. But what I want to say is that's another big vision, I think, that actively now can pursue, and there are governors here in the Euro system, and can think of ways of using it as a strategy. Now, if that's true, it's a final thought that maybe that leads us further to the discussion, is that, however, I think global Euro starts at home, and the Euro adoption is not finished. And this is a very interesting idea that maybe we can discuss a little bit later.
Yeah, global euro indeed starts at home, but I also feel like, the idea of the euro currency stepping in to compete more with the US dollar is also the idea that, oh God, it's been on the agenda for quite a while as well. So let's look at some of the reforms that are done, have not been done, and maybe something to reinforce. And specifically, I want to go with the more details on the EU-level action that could help the region. I'm trying to bring it more a little bit to the region. Ivailo, I would like to ask you on this one as the second part of the panel. Another, euro stepping in against the US dollar, and another very buzzword notion of structural reforms. Let's go a little bit more on those regarding the EU-level structure and reforms. Specifically in this case, when it comes to such an important aspect as goods and services, what among those could possibly help the CESEE countries close productivity and investment gaps, if we can identify those?
Sasha, you're asking me about EU-level reforms?
Yes.
Okay.
EU-level reforms.
So I don't think structural reforms is a buzzword. It's been around for a very long time, and it's been around often because, we do it, and then more often we don't. But I think, Draghi report was issued almost 9 months ago. And so we're all waiting with great anxiety what the follow-up would be. So far, the follow-up has been a summary of it in the form of a competitiveness compass, and there was this idea about the single market last week. But what are the specifics? And I think the specifics we all know, as was highlighted many times in the previous panel, this panel, we all know, and the Draghi report also summarizes them. How do we simplify regulation, remove unnecessary, burdensome regulatory barriers within the EU, and harmonize standards? So, you know, often if I produce something in one country and I paint it with some paint and there's a national certification that this is safe and I export it to a different country, often it has to be recertified. It's a huge problem. It's a huge barrier. If I produce something in one country and try to sell it on the Amazon.fr, on the French website, I need a local tax lawyer. I mean, it's super complicated. So these things have to be simplified, and I think it should have been done many days ago, should have been done yesterday. You know, the other thing is that for services, we have these national professional silos. I graduate with a law degree in Italy, I cannot practice in France. I'm an architect in Bulgaria, I cannot be an architect in Austria, right? And so these are huge problems. If there are issues with national certification bodies, I think these could be resolved. There are ways to do that, but otherwise creates. And so when the IMF quotes this 111% of GDP, the regulatory equivalent in terms of tariffs, I don't know whether the number is exactly right, but I think these barriers are super huge, and especially for service, and especially for a post-industrial region where services, and especially high value-added services linked to AI, and I see Anton here is going to talk to us about it, right? I think these barriers are often difficult to understand and difficult to accept after so many years of trying. The other, of course, is that, you know, the Savings and Investment Union, I mean, we keep talking, and the Draghi report summarized that, you know, of all the unicorns in the US, many go to the US, right? Let's say, of the $100 that go into AI, 66% go to AI in the United States. Only 6% go to European companies. In terms of research and development, yes, there are parts in Europe, countries in Europe, Sweden, Germany, that spend a lot on research and development. On average, not that much. We lag dramatically on patents, where we used to be on par as a global share in 1990 with the US. Now we are half that share, and China is doing faster than us. And so therefore, how do you scale up? How do you get that union, saving and investment union, to allow companies to scale up and to be much more dynamic and to expand faster? Something I'm going to probably also talk later if you ask me about the CESEE countries specifically. But in the EU, this focus of support on SMEs in general, small and medium-sized enterprises in general, rather than on size, I think we should focus on value. What do they create? Do they create jobs? Do they create exports? Do they create innovation? Do they support technology adoption? Why are we supporting, you know, subsistence entrepreneurs? Why do we support the corner bakery? Why do we support the corner dry cleaning store? I think it also requires, so a lot of these things are at the national level. A lot of these things would require some kind of consensus. But I think it's absolutely essential. We need to make our business environment much more dynamic. Companies have to run faster, given the circumstances around the world.
Debora, while we are working on those, as Ivailo just mentioned, what do you see as, in this case, the greatest untapped potential within the CESEE region, and how can, you know, this deeper integration, including the aspects and the Ivailo mentioned, help the region face better the European fragmentation and the global fragmentation at the same time?
I think still one of the strongest potential of the region is related to the dynamic industrial base, and that's actually one of the elements that I think the region really has to continue to cherish, also because with the all global adjustments, actually the region could gain a part of the readjustment waves. We have seen, so we were trying to look at the shocks of the past years, so not yet this shock, but the previous one, the pandemic, all the Suez Canal, etc., and how European firms have been adjusting to those shocks. And I think it's interesting to think also for the future challenge coming. So what we've seen is that when firms were affected by the big disruptions of the last years, the first reaction has been a lot of investment in inventories, in digital tracking, that is a way for managing better your value chain and know where the problems are happening and how to adjust. And then the last point was a lot of diversification. So rather than complete retrenching, creating an alternative on your supply. And on that side, Central Eastern Europe was also one of the opportunity on the diversification, and that was a positive element. So in fact, this tells us that even in the new global readjustment, Central Eastern Europe can get a little bit more of this intra-EU market diversification effect, and can be positive for the region. There is one element that I think is quite important for the region and for the consideration that will be taken at the European level overall. The region actually has quite strong ties, we said, not so strongly affected directly by the US, but indirectly, but the region has stronger ties also with China, both on the industrial manufacturing import side, that is important, and FDI in the region, and also part of innovation related to some of these FDI. So the way in which Europe will define strategic autonomy and the decision that will be taken will be quite important for the region. And I think, in fact, diversification is the key word. Diversification means you don't go only on one side, you protect, you make sure that you have alternatives, but this is a very important point, I think, for the region to be defined. There is, talking about the potential, I think there is another element that we try to keep on top of policy attention, that I think it's also quite relevant for the region. We talk a lot about climate change and the climate policies. Now climate seems to be a bad word in the US and some other part of the world. But I think for Europe and also for Central Eastern Europe, there are various reasons why it remains central. First of all, Europe is an energy importing continent. And having a transform energy sectors, which is more diversified, if you want, but also more self-sufficient, is extremely important. So the whole transformation of the energy market through renewable, through energy generation, internal energy generation, potentially also nuclear could be, is something that is in the interest of Europe. And will also be very beneficial for the corporate sector in the medium term when prices then will adjust to the new structure. But also it's not only the energy market side, but it's also the green tech sector that is quite interesting. We all talk about the fact that China is excellent, but it's true, China is excellent, but Europe is also very good. Actually, there has been a very strong growth in the market of green tech export product, and Europe is catching it. CEE region is really catching it. So it's actually a good sector for Europe to continue to invest in. And also on the innovation point of view, true, China is very good, but Europe is at the center of innovation networks. So on my side, the potential is also really keeping the net zero policy and strategy really firm at the center also for the region and for Europe, and that will also bring opportunities. So if we talk about the potential, I think that's an important one.
Piroska, what do you think on that, when it comes to the potential, as Debora mentioned?
I very much agree with the potential. I think maybe I point out another avenue for further protection. And that, given that this is a central bank, so National Bank of Croatia and IMF conference, maybe it's appropriate to bring in potential monetary policy tools that can also further integration. What we are looking at, right? And what the region can do and what Europe can do, sort of old Europe, advanced Europe, as you wish, can do for the region. And let me make the pitch for what is now being discussed in the corridors of central banks in Central Europe, more vividly, I think, than before, after the post-COVID inflation fighting period, and given the security situation on the Eastern Front, is that the benefits of being in the euro and the euro as an integrating tool is back on people's minds' agenda, if it's not still on the political, openly the political policy agenda. And that is based on new evidence, not on all debates whether this region is an optimal currency area with the advanced Europe, or debating whether the euro is an appropriately completed project, given that there is no fiscal authority, central authority, and all the rest of it. So the problems with the structure, it's not related to some perceived benefits, imagined benefits of monetary sovereignty for very small open economy next door to a hopefully more and more global reserve currency. So we have to look at new evidence, not old dogmas, if I may put it a little bit too harshly. New evidence. What's the new evidence? The new evidence is that fighting inflation in Central Europe, where countries were similarly hit, we have similar structures, similarly hit by the COVID crisis, obviously, but then the Russia imperial war impact, the energy crisis. So, but have different monetary regimes. Some countries are in the euro, have been in the euro, fighting this, and others enjoyed still, outside monetary policy sovereignty. So it's important to compare how the two regimes in this natural experiment, same shock, same structure, but different monetary regimes, how they compare. So we compared with Rainer Martin, National Bank of Slovakia, we compared inflation fighting performance of Slovakia, which is in the Eurozone, obviously, and policies, member of the ECB and all that, and policies come from the ECB. With that in Poland, the Czech Republic, and Hungary. So evidence. What's the evidence? What's the test from this? And the evidence is very clearly that inflation actually, despite the same shock, same structure, the inflation was the lowest in Slovakia, being in the Eurozone, even though the ECB started increasing, and thus Slovakia started to increase interest rates belatedly, arguably, and that's a strong criticism, I think, ECB, other advanced countries started later, but they needed actually much less of an increase in interest rate to fight similar inflationary pressures than what Hungary, the Poles, and the Czechs had to endure. So the sacrifice ratio one way or the other, so the output decline required to bring down inflation, 1% of sort of a unit of inflation, was lower in Slovakia. Clearly benefit, despite this delayed implementation in the ECB policies reacting to the inflation pressures relative to monetary sovereign countries enjoying monetary sovereignty. inflation was lower, cost of bringing down inflation much lower. On top of it, Slovakia enjoyed the benefit of being, enjoying the benefit of a massive, more credible, and massive balance sheet central bank, the collective balance sheet of the ECB. And they didn't need to beg for currency swaps and repos from the ECB, which all these countries, of course, outside needed, because much of the trade is already in euro. So overall, this recent experience would suggest to an economist that there were scarcely no benefits from monetary sovereignty fighting inflation, and there were only upsides given of membership, given lower inflation, and given much easier crisis management within the Eurozone for a small open economy than outside. So this, sorry for the long story, but I think it's very important to internalize and look at new evidence of euro integration now, and countries to do, I think, everything that is possible to line up, where trade is already, concentrated, where invoicing is in euro, where there is a preference for the euro, where 50%, up to 50% of deposits and loans are in euro anyways, even if when you are outside, and do everything that is needed to get into the euro. The euro, in the end, has been as much a political tool as an economic tool. I know central bankers don't like to hear that. This is a separate thing, monetary. No, this has been a political project. So let's complete the political project with the necessary gray rights, with the necessary conditions, maybe a little bit better, and look at more, generously at certain cases, such as those countries in this region, which unilaterally had to adopt the euro as part of their EU-sponsored peace plan, Montenegro, Bosnia and Herzegovina, and they're already using the euro. So maybe a little bit of more out-of-the-box thinking in Southern Eastern Europe on top of everything.
We'll have to wrap up this part, because I'm afraid that we're going into the conclusion part, and I want to hear more about this later. Zsolt, let's conclude this EU-level action part that we are trying to somehow wrap up within a couple of minutes here. I want to specifically ask you regarding the recent reinforcement progress, if you could comment on that one, and also the issue of better alignment and use of the EU funds with this regard.
Thank you. So let me again start with a higher level comment. So EU legislation can take two main forms. One is regulation, and the other is directive. When it's a regulation, it sets clearly from the first to the last sentence what countries must do. Mm-hmm. If it's a directive, then it sets the broad guidelines, and countries have to transpose them into their national laws, national legal systems. Now, almost all single market issues are directives, not regulations. So EU countries could decide, okay, instead of directive, we have this regulation which fully specifies, for example, how architects should operate within the EU, and there would be zero barrier for one architect moving from one country to another. But EU countries don't want that, so they instead opted for directives, and then countries have to obviously incorporate those directives into the national legal systems, and this is where the problem comes. So I think when we are blaming, limited or still frictions and excessive burdensome cross-border provision of services, we primarily have to blame EU members for not going for regulations, but instead directives. Now, there are lots of tools available for the European Commission, which within this political framework tries to enforce still as much harmonized national implementation as possible. So one is, for example, the transposition. So the Commission reports a so-called transposition deficit, in which it looks at how many countries have failed to transpose a certain EU directive, and also whether it's just a recent directive or directive that has been there for long. So I just looked at the recent scoreboard. For example, Croatia is somewhere in the midfield of EU countries. Slovenia is in the front runner. Bulgaria is in the lagging countries, so not that surprising given the institutional quality. Another is the infringements, and another indicator is so-called this conformity deficit, which looks at after transposition whether how much it indeed aligns with, is it in line with the principles put forward in the directives. And if I look at my own country, Hungary is among the best in transposition, but one of the worst in the conformity. So it seems that Hungarians transpose very quickly and everything, but they don't do it properly. So there are lots of infringement procedures, and indeed the Commission, that's a legal procedure that the Commission is pushing countries to do that. There are also lots of alternative, somewhat softer tools to enforce the single market. There is so-called EU pilot dialogue, which is a kind of informal exchanges between the Commission and member states, trying to help them. There is a big information system called Internal Market Information System, which connects, across border, local, central authorities and everyone. There is also a notification system. Whenever a country does something related to the single market, they have to submit a notification. Again, I just checked the recent Commission report from this year, in which they reported that in 2024, 755 draft technical regulations were notified to the Commission. So instead of having, of course, there are many different products and services, but instead of having standardized requirements at the EU level, national governments and parliaments decide on their own. Then they have to notify the Commission, and then the Commission checks whether they are in line with the EU and standards, and sometimes find it is not, and request changes. So again, I think that so again, to blame, I would rather blame member states for not going for EU-wide regulations. Now, if you look at what happened in the region, I mean, for example, the transposition deficit went up, during the COVID crisis. It came down a bit. The conformity deficit is going up and down, so there is no permanent changes there. But certainly, hopefully, all these tools are, helping countries, and these super lengthy Commission reports always conclude that, oh, these are working, countries are improving their regulatory alignment, their labor markets, legal convergence, and so on and so on. Now, on your second question on the EU budget facilities, or second part of your question, now certainly, I mean, the region is certainly the prime beneficiary of various structural funds, and I'm looking at the clock. So what could be done is already to some extent implemented in cohesion policy, but also more forcefully in the recovery and resilience facility. It is somehow giving a conditionality for certain reforms and investments, but in this case we are talking about reforms to reach EU, I mean, certain reform requirements, and then the countries get the funding. I think that's a way indeed to push countries to indeed try to do these very difficult reforms, which again in the region, being a main beneficiary, might be an effective tool.
Right. And you kind of brought us to this third part when I want to ask all the speakers regarding the political and institutional obstacles as well. But before I do that, could we please bring back the poll? We're going to reopen it now. There's no pressure. Well, there's about 10 minutes you have. Look at it again, and we're going to keep it open, as I want to go for the final thoughts with the speakers about the political or institutional obstacles when it comes to preventing deeper integration. Ivailo, may I ask you of those when it comes to the need for more of political will?
I mean, you know, when countries join the European Union, you give a lot of sovereignty, right? And so therefore, subsequently, trying to streamline regulations, make business easier, you know, stop coddling incumbents, promote technology adoption, innovation. I frankly don't see that as much of a loss of sovereignty as rather, I mean, how do we make for a much more dynamic both countries and a more dynamic union? And obviously, for the small and open economies in our region, especially those that are not members, but even the EU members, having a dynamic and vibrant European Union is crucially in our national interest and would certainly enhance our sovereignty. So I would not agree with some of these conclusions here.
Thank you. Debora, to you.
I think I'm thinking also at what can we do as an institution to support more actually the European approach. And I think I come back to what we have been discussing a lot, and also Dombrovskis was mentioning. If the objective is really this simplification, integration, and investment, then institutions like us can do a lot on the investment side to try to bring more resources also toward the projects that are more on the European point of view. And from the EIB side, we are actually, now we are asking our shareholder to allow us to expand our activities to 100 billion lending per year. And we have a few elements which I think can make the difference. And not only us, also other institutions can do it. But I think it's quite interesting to look at. First of all, we are in a moment with many diverging priorities in terms of investment and public investment. And I think there is a rule of rethinking how to have financial instruments that are actually ways in which the public sector, they risk investment for the private sector to intervene. In the region, there is still very little use of these financial instruments, and I think it's very important to catalyze investment in specific policy area. This is one point. The second point, as I was saying, as an institution, we continue to have a very, very strong focus on climate, and we are adding an additional focus, which we already had, but we are expanding it in terms of innovation finance. Actually, we are coming up with a proposal on TechEU that will come hand in hand with the Commission proposal on scale-up strategy, that actually is really looking at the innovative companies that fail to scale up at the European level. And we are looking at reinforcing specific part of the process. We think that we need larger venture capital funds also to support scale-up funds. We think that we need to do more on venture debt and make it easier for companies to tap these resources. And the very last thing, if I may, I think there is a very important point for institutions to look at what is the future of public support to the private sector. And we have to work more on instruments that are European level, because everything that is done at the national level distorts the single market, while European instruments, our study really show that they limit the distortion of the market. So they actually incentivize all the upside that we know in terms of a European single market.
Sorry, I have to cut this. For the final thoughts, Piroska and then Zsolt, you see the timer as well as I do. You have 2 minutes each. Sorry about it, but we need to...
Okay, so short, big picture. What is the single most important obstacle to institutional change? Is the political economy stupid, to paraphrase President Clinton? We are in a situation, as Minister Boščančić very shockingly said, you know, we are in permanent crisis, permanent crisis. Now, there is a host of literature on institutional economics which looks at the positive role of crisis, right? Because it can prompt change. Milton Friedman famously said that crisis made what was politically impossible, politically inevitable. So do we have a crisis? We bloody hell have a crisis on our hands. We have a double crisis, twin crisis, as I was trying to say at the beginning. We have the military crisis, and we have an economic slowdown, stagnation crisis. So use that crisis, and here, one has to turn to the political leaders, sell this, make the population internalize. Unfortunately, we are not in a peacetime, we are in a wartime, figuratively and real, and focused on that, and energize and make change that only crisis can bring about.
Before I give you the final words, Zsolt, look at this. So just let's compare what we had. We still have giving up part of sovereignty as the winner, so to say, with 58%. In the beginning of this session, it had 61%. So you can see it went down, but not too much. The second, political positions too far apart, had 54 in the beginning, has 52 now. Cannot compromise was at 41, now at 37. And this one, the D one, is a very interesting one. Benefits not clear. It now has 29%. It had 22 before. So I'm afraid that it got even less clear during our session, which is an interesting twist here. Too many countries involved was 22, now got to 27. We keep ramping it up. And high budgetary costs, 17, now used to be 20. Zsolt, you have your 2 minutes. You have it.
So I think that the main answer is so how to foster greater integration and reforms in member states. It goes back to the question whether the current fragmentation is due to political will, namely that countries still want to have some little frictions to benefit their companies, or inability. For example, they have insufficient technical knowledge and administration is ineffective. It also depends, what is the solution. The Commission last week proposed, first of all, reinforcing all the existing mechanisms for single market enforcement. Additionally, they proposed a so-called high-level Sherpa within each country, and the aim of that person would be to coordinate, the various single market measures done within the country. Now, if the main obstacle is indeed political, that countries do want to preserve some differences in their national standards and requirements to protect their domestic companies and service providers, then this wouldn't help. But if the problem is indeed some inability, then this might help, and indeed there is also a lot to do also on the European front. I mean, then certainly capacity building. Commission also has lots of technical instruments to support the actual implementation and transposition implementation of laws that help a lot. Another one is this instrument, which is so-called the European semester, which is probably is an annual cycle of policy coordination, and in every year it results in recommendations on very diverse topics. And this is number of recommendations are relatively limited, so probably those focus on the most critical issues. But if you look at the implementation is very, very poor. I mean, the Commission is writes some triumphant reports that implementation has increased. When I look at the same data, I don't see it there. So, for example, issues like business regulations or various kind of governance issues like operation of courts or labor market laws, there is basically very limited progress in there. So again, the European tools which should force countries or incentivize countries to better align their national domestic regulations with the single market. But if countries don't want to do that, then the Commission can do whatever it wants. Unfortunately, it will not achieve much.
Thank you. Zsolt Darvas, Senior Fellow at Bruegel, Piroska Nagy-Mohacsi, Professor at London School of Economics and Political Science, at Debora Revoltella, Chief Economist at the European Investment Bank, and Ivailo Izvorski, Chief Economist at the World Bank. Thank you very much for this session. Thank you.